Good morning, hello and welcome on to Trading Hour. We're dealing with an extremely weak start to the week once again. I'm Surabhi Upadhyay. With me on the show is Reema Tendulkar, and it's a market that has been consistently falling under its own weight. The weakness that set in last week, well, if Monday is anything to go by, at least so far, the buyers are yet to come in. And the market has also been fiddling around with a lot of critical levels as we look at things right now. So we are about 40-odd points off the lowest levels of the day. The day low was 21,821. We're at 873. But the fact is that a lot of critical levels have come and gone, and the 100-day moving average is in play. The market's, of course, trading below that right now. The 100 DMA comes in at 21,990 thereabouts. But the Nifty is finding it hard to stick to it, and the cuts in the broader market are even deeper. The mid-cap index is down well over 1.5%, and the advanced decline ratio is telling you so early in the morning, and you already have nearly 2,000 stocks that are on the declining side. Reema, hi. Weak start to this week.
Very, very skittish, right? And the problem is that the broader market continues to underperform day after day. You know, last week, the small cap index was down 5%. And after that kind of a fall, the small cap index is again down a similar amount. So month to date, while the Nifty is down about 3.5%, the Nifty small cap index is down 7.5%, the mid cap index is down 4.5%, and PSUs have taken the biggest brunt of the selling pressure, and they're down close to about 10%. You know, you spoke about levels. While the 100-day moving average level has gone today with the fall that we've seen, there is the 100-day exponential moving average, which is also tracked, the 100 DEMA as it's called, and that's at 21,822. So we're still holding on to that. Even the low today was above the 100 DEMA, the exponential moving average. So that's going to be an important level to track. But lots of cues lined up for the week. There are 3 Nifty companies which report numbers: Bharti tomorrow, GAIL, JSW Steel. Today we had Indegene listing, but later on in the middle of the week, you've got Aadhar Housing Finance, TBO Tech, which will be listing. India CPI, US CPI later on. And not to forget, Saturday is going to be a trading day. So while 20th is a holiday and everyone should go out and vote, but 18th is going to be a market trading day, but albeit just a half one. But so much happening on individual stocks, right? Tata Motors was the biggest gainer last year, and today it's leading in terms of losses.
Absolutely. I think, the fact that they're a little sanguine on FY25, that guidance has just not gone down. And a lot of the brokerage notes lead with the question, is the best behind? And that's why this stock is really taking it on the chin, about 9% lower. We'll talk about this as we go along. A couple of other names in focus as well. Very sharp result reaction. So on the way up, you have a BEML play, for instance. Look at BEML. Those numbers have been really fantastic. Margins expanding, top line improving, and there's a 12% rally on BEML on a day like today, when the rest of the market is so weak. ABB India's performance has been very, very robust as well, and 8-9% up on that stock too. So we'll get you more color on a lot of these movers and shakers. I just want to highlight a couple of the PSU banks. Union Bank of India and Bank of India, both of these stocks are down on primarily, the big trigger is asset quality concerns, because slippages have been rising for both. Now, the Union Bank management was in conversation with us just a while back, and the management there, at least for Union Bank, the management indicated that this is a seasonal issue. The rise in agricultural slippages is a seasonal issue. And the top leadership of the bank promising that even in MSMEs, whatever slippages the bank has seen, they're fully collateralized. So they don't actually have any asset quality issues. They're saying that the asset quality will improve, with the gross NPA falling to sub 4% by the end of the year. But right now, the market is not in the mood to buy any of that. It's just a sell-on news that's playing out on a lot of these individual stocks. So I guess we'll analyze this as we go along. But remember, the fact is that the jitters that we were discussing last week as well, elections, uncertainty, just lightening up of positions, all of that is still continuing.
Yes, the VIX was up more than 10% on the opening tick itself. So the India VIX, if you could pull that up, it has crossed that 20 mark. I think 12.5% higher the last time I checked, about 15 minutes back. So that indicates, the kind of nervousness, the anxiety in the markets right now. But let's straight away get to Indegene, and what a fabulous listing it's had. This is a company which provides digital solutions for businesses engaged in the life sciences, and they've had a very good listing. The stock had listed at 655 rupees per share, much higher than the issue price of 452. The gains have settled a bit. It's still holding up with a 25% gain at 568. We have Manish Gupta, the chairman and CEO of Indegene, the newest company to be listed on Dalal Street. Congratulations and thank you very much for joining in. This is Rima here. Now that you're listed and you have a lot of shareholders to answer to, if you could give us, Manish, some indication of the kind of growth. In FY22, your top line growth was 72%. In FY23, it was 39%. And in the first 9 months of the year, growth was about 15%, 9 months of FY24. It's the growth rates, at least the historical growth rates that we have, which is about 3 years, seem to be, they're not giving us a sustainable trend. So if you could guide us in terms of what can this company grow at and what is that, investors, your new shareholders should expect on the margin front.
First of all, thank you so much for inviting me to this discussion. Thanks a lot for that. Now, as Indegene, we have had strong growth rates over the last few years for sure. But even before that, we have grown from a very small company, started out of a house in Bangalore, to a global company with more than 5,000 employees, working with all the top 20 pharma companies, 65 active customers, 18 offices across the world. So there's been secular growth over all these 25 years. While I'm not guiding to a specific number, this is an industry, the life science industry is a large industry, $1.8 trillion, north of $1.8 trillion. This is also an industry which continues to grow. This is an industry which continues to outsource more on a lot of the operational activities in which we operate in. This is also an industry, even in these operational activities, they are shifting more and more their spends and ways of doing things to digital first and AI-driven ways of doing things. And we as Indegene, by combining our domain expertise and deep tech platforms and tools, provide very unique solutions. To that extent, we are bullish about the future.
And what can drive margin expansion for you? You've seen margins of 17% going up to even 19% approximately. What are the triggers for margins from here on?
So you think about it, margins, I'll answer that question in two parts. One is, even before I go that, from a financial perspective, we've been always a very robust company, right? Whether it's growth, EBITDA margins, PAT margins, or cash flow generation. If we are EBITDA margins during this period of significant growth you just alluded to, 18.8 or 70% growth, our EBITDA margins had dipped to around 18.8. Since then, they have had a northward trajectory. In the 9-month ending December 31st, we did 21.9% EBITDA margins. And our attempt is going to be continue to sustain and grow these EBITDA margins. At a PAT level, our margins were a bit lower, and that was primarily because of a loan we had on our books, which was done. This was taken to do an acquisition in 2022, and of course the interest cost had had gone up over the last few quarters. Now, with this public issue, one of the objects for the primary raise was to pay down this debt. So to that extent, we will have an impact on our PAT margins as soon as we pay off the debt, and they're going to go northwards.
How much higher? I mean, since we're talking numbers right now, Mr. Gupta, let me complete this part of the conversation. Once the debt is paid off, what is the margin headway that you see ahead, and over how much time do you think you'll achieve this?
So our PAT margins are in the region of 12.8ish or so right now. The debt impact itself, the debt impact is more than a percentage point. Actually, if I'm not right, it's around 1.2, 1.3 percentage points. And that's going to be done in the real near term, right? We will be paying off this debt very soon.
Okay. And how much is it in absolute numbers, the debt that you'll be paying off? And, will the proceeds that are coming to the company, crores. 390 crores. Okay. So that will be entirely paid off.
Yeah, absolutely.
Okay. So now let me just dial back on.
And the interest cost we have been taking is 30. Sorry,
okay. Okay. Got it. So, that's, one large chunk of funds and how they'll be utilized. Let me just dial back on a couple of other basics that quite a few of the private equity backers of the company, they are also sellers in the IPO. I mean, it's been I think a partial exit for them. But can you just tell your shareholders what the sort of the PE players' plan is when it comes to Carlyle and Narrowther Far East? What level of equity have they committed to keep holding in terms of the conversations you may have had with them?
See, first of all of them have a lock-in period, and of course they're going to be abiding by those lock-in periods. But again, going Indegene is a very unique company outside of the management team, which has been a very stable management team for a very long period of time, and is very motivated to continue to grow the company for a long period of time. One of our investors, Narrowther Far East, as you said, has been an investor for now almost 20 years, right? And I believe they're taking a very long-term view of the business, right? Now, the other two private equity firms, we are really humbled that they, after 3 years, cut down what they're planning to sell in the public issue and have sold lesser than the initial plan. And are taking a very positive view on the company. Now, of course, their plans, specific plans, is something I can't comment on.
Oh, okay. Just very quickly, I mean, we'll require far deeper and lengthier conversations with you, and we'll look forward to that now that you're a listed company. Yeah. But just in a nutshell, out of your 3 business segments, if I just look at the breakup, enterprise commercial solutions is the biggest one. Omnichannel activation is relatively smaller. I guess that's where your AI and sort of, deep tech prowess comes in. And there's enterprise medical solutions. Just tell us which one is going to be the real growth kicker for you? And I mean, will you be dealing more with companies beyond life sciences companies as well? Just the sort of pharma segments that you plan to cater to in the near future.
Sure. So let me first of all tell you over there that all these 3 segments we bring to fore our deep domain expertise and tech prowess in all these 3 segments. How we bring it, right, and the instantiations are slightly different, but nevertheless, we bring all these capabilities together. We see tailwinds across all these segments, and there is significant amount of domain expertise in tech and growth opportunities in all these segments, and we'll continue to invest in all of them. Now, as far as going into different sectors, at least we don't see that as a we're not thinking about that right now. This industry and the segments we operate in, actually within that, even our existing clients, we believe offer a tremendous opportunity for growth, and we'll continue to put our head down and execute in the segments we operate in for the clients primarily we are working with.
Thank you, Manish, for joining in, and wish you all the very best. Get into a break. On that note, on the other side, we'll get chatting with the management of Bank of India to discuss their 4th quarter numbers. Stay tuned. Welcome back. Let's talk about Bank of India. The stock is under pressure because of the sharp rise that we've seen in the slippages of the company, and even the credit cost is at a 12-quarter high. That said, the loan growth of the company is pretty strong. But the stock, as I said, is down 11% because of the rise in slippages. Rajneesh Karnatak, MD and CEO of Bank of India, is now with us to take a few questions. Thank you for joining in. First, if you could explain this quarter-on-quarter increase in slippages, what happened and which is the segment where we've seen an increase, and what can you guide going ahead?
Yeah, so as far as the slippages in the Q4 are concerned, you can see that the increase has been there in this quarter. However, the increase is because of the fact that there has been some slippages in the agriculture and the MSME book, typically the small MSME book and the agriculture book. However, if you see on the year-on-year basis, the slippages have been lower than the year. In FY23, the slippages, whatever were there at around 7,500 crores, this year it has come down to 7,000 crores. YOY it has come down, but on the Q4 number, definitely, as you rightly said, it has gone up.
And has that trend continued, sir, even in Q1, the slippage increase in agriculture, MSME? And what would be the quarterly run rate on slippages, at least in the first 2 quarters, as you see it?
Yeah, so as far as the guidance for Q1 is concerned, whatever the slippage was there in Q1 of FY24, the slippage for Q1 FY25 should be definitely lower than that.
Okay. But Mr. Karnatak, I mean, you're right now at an annualized slippage ratio of 1.45%. Where do you see this number, let's say in the first half of the current year? And, how are you confident that perhaps this, especially the agri slippages, that this will not become a recurring phenomena in Q1, Q2?
So normally the slippages in agri happens during the half year, basically in March and September. So the slippage ratio, as you rightly said, is on a higher side. But the slippage ratio, if you see on a year-on-year basis, it has come down. From March 23, whatever the number was, it is lower than that in March 24. So as far as the guidance is concerned, for March 25, the slippage ratio will be better than this. It will be lesser than this number, definitely for March 25. So I am telling you on the backdrop of the fact that if you see our SMA numbers also, so the SMA number was around 17,000 crore, above 5 crores. As on March 23, it has come down to a good 7,000 crores only as on March 24. So we are curtailing the fresh slippages now through better SMA management, and SMA book has now come down.
No, sir, just for the sake of clarity, can you give us two numbers? At the end of Q4, your slippage ratio is 1.45%. Where will it be at the end of FY25? And likewise on gross NPAs. Gross NPAs have been coming down, no doubt. They're at about 4.98%. You're just under 5% at the gross NPA level. Where do you see this number, or where do you want to target this number by March 2025?
Yeah. So as far as the slippage ratio is concerned, we are targeting a number of around 1.20% for the slippage March 25 slippage ratio. As regards the gross NPA number is concerned, you have seen that the gross NPA has come down from 7% plus to 4.98%. We expect further it should be at around 4% in FY25. So we are focusing a lot on recovery not only in the cash recovery and upgradation, but also on the recovery in our return of accounts. So that is one part. Apart from that, there will also be a reduction in the fresh slippages through better cash monitoring and collection efficiency. All this will help us reducing our gross NPA further down from 4.98 to a level at around 4%.
Okay, so gross NPAs come down to 4% and your slippage ratio comes down to 1.2% by the end of FY25, right? That's the guidance. So
exactly.
Out of the quarterly slippage of 2,038 crore that you reported for the March quarter, what was the number for agriculture and MSME?
So agriculture and MSME contribute nearly around 50% of the total slippages. So more than 1,000 crore has gone into agriculture and MSME.
Sir, just a final point on asset quality. You are saying that you're expecting good recoveries. Can you share some ballpark numbers with us? Maybe first half, how much are you hoping you can get back by way of recovery? And also a word on write-offs. When you say you'll go down to just under 5% to 4% gross NPA, are you factoring in high write-offs as well? Or is it largely because of recoveries?
So it will be a combination of write-off and recovery. So if you see our numbers for this year, we have done a fresh slippage of around 7,000 crore in the entire year, which is less than the fresh slippage which happened in FY23. So this Q4 number has been a bit of a aberration for the fact that the slippage has been high. However, in the year-on-year basis, March 23 to March 24, our slippage has come down on an absolute number, on an annualized basis. So what we are saying is that if you see our numbers further, the fresh slippage is around 7,000 crores and the total recovery which has happened in the bank, which includes cash recovery, which includes recovery from return of accounts and also upgradation, is more than the fresh slippages. So the ratio is more than 1, which I am not including here write-off. If you include the write-off, the number is further higher. So we are fundamentally strong as far as recovery is concerned, and we expect that the recovery will be 1x plus in this financial year also. So whatever the fresh slippages happens, we will be recovering more than that, which includes cash recovery plus upgradation and plus the recovery in the return of accounts, which we are not including the write-off here, because if we include the write-off, the number will be much higher, in fact, on the reduction on NPA side.
So what's the guidance on advances and the deposit growth for FY25?
So as regards our advances and deposit is concerned, you can see from our slides also, presentation, our global advances have grown up by nearly 11 to 12%, and our deposit has grown by 10%, and overall the business has grown by 11%. Advances in fact have grown by 13% plus. So the incremental business increase has been 1.38 trillion in the bank, out of which advances increased by around 69,000 crores and deposit grew by around 68,000 crores. So for the guidance for March 25 would be on the deposit side 11 to 12% and advances side 13 to 14%.
Okay, and what would this do to your net interest margin? What is the expectation in the first half and even for the full year?
Yeah, so if you see the net interest margin, it is also derived from the net interest income. If you see our net interest income for this financial year, year-on-year basis, the net interest income has gone from 20,000 crores to 28,000 crores, which is an increase of nearly 14%. On the net interest margin side, if you see the global NIM, it is at 2.97% as against 3.01% from the previous year, and the domestic NIM is at around 3.4%. So the guidance for the financial year 25 is on the net interest margin side is that our net interest margin on a global level should be at around 2.95%, and this net interest margin on the domestic side should be at around 3.35%.
Mr. Karnatak, just to go back to the asset quality point, I had one last question on it. On the restructured loans, I mean, on slippages, you've told us that your recoveries will be in excess of slippages at an aggregate level. On restructured, as of the end of this quarter, I think your restructured book is just under 7,900 crores. Now, what is the quality of this restructured book? I mean, how much of it can you realistically say perhaps it will slip? How much do you think has the potential to, to be upgraded in the coming quarters?
Yeah, so whatever the slippage in the restructured book had to happen has already happened. So this restructured book has a combination of NPA and the standard book. So we are not seeing much of slippage in the restructured book as such. So whatever had to slip has slipped, and not much of upgradation will also happen. The upgradation will only happen in a very few amount of upgradation will happen in that. So the restructured book will be static, will remain as good as that, because any fresh restructuring we are not doing, because as you are aware, as per IRAC guidelines of RBI, any restructuring tantamounts the account to become NPA.
Okay, thank you for fielding all these questions on asset quality, sir. We'll end on a happier note. Like you said, that your guidance on business growth is about 11-12% on deposits, 13% on advances. So just tell us, 13% growth of the book in this year. Which are the segments that you think will drive it for you?
Yeah, so RAM growth is quite good. Retail, MSME and agriculture, all the three heads we are growing quite better. As far as the agriculture is concerned, our growth is around 16%. MSME is around 10%, and on the retail side it is around 18%. Overall RAM growth is around 15%. On the corporate book, our corporate book is around 45% of our total global loan book. In that we have seen good credit growth. In fact, our credit pipeline is around 50,000 crores as on 31st March 24, which we expect to be disbursed in Q1 and Q2 of this financial year. Out of that 50,000 crores, around 37 to 38,000 crores in on the corporate side, and 12 to 13,000 is on the RAM side. In the corporate side also, let me further clarify to you that it is well spread out in the infrastructure, both power sector, road sector and port sector. On the industry side, it is there in steel sector, textile sector, pharmaceutical sector, chemical sector, petrochemical is also there, oil is also there. Apart from that, there are certain government initiatives where also we are lending under the Gati Shakti initiative, under the PLI scheme also we are lending, and also ethanol sector we are lending. So all come together, there should be a healthy credit growth during this financial year.
Thank you, sir, for joining in. That's Bank of India. Disappointing in terms of the slippage performance in the current quarter, but the management is guiding for an improvement as the year goes by. 1.2% should be the slippage ratio in the next 12 months. Get into a break. We'll discuss market technical. Soni Patnaik of JM Financial Services joins in on the other side. Okay, welcome back. Tata Motors is the big stock on our radar right now. It's down close to about 9 to 10%. Sonia is now joining in with what went wrong with Tata Motors this time. Sonia, Tata Motors was like the big banner, outperforming stock of last year. It was a banner year. They listed Tata Tech, improvement in the guidance on JLR, debt levels came down. What happened in the quarter gone by?
There were no problems with the numbers. The numbers were fine. I think it is the commentary from the management that, put a sort of a stoppage on the stock. Now, if you look at it, there are a lot of brokerages that have come out with their with downgrades on the stock post the numbers. So I wanted to talk a little bit about that. The conference call highlights, of course, are on your screen, where the management does talk about a flat performance for the JLR EBIT margins for FY25. They say that costs have also moved up. There are increasing marketing spends, etc. And they maintain a 10% EBIT margin for JLR in FY26. They maintain the guidance of JLR becoming debt-free by FY25. So that is fine. But they talk about many challenges both in the global as well as in the local markets. And hence, they refrain from giving any volume guidance for FY25 for the Jaguar Land Rover business. So largely, you'd have to say it is the cautious commentary from the management. They said that in many regions globally, the demand will be quite difficult demand pickup will be difficult in several regions in FY25. And Q1 is likely to be weak, although they expect the free cash flow to be neutral because of adverse working capital. Now, many brokerages have downgraded the stock as well. I think that added to the uncertainty on the stock. Nomura downgraded the stock to a neutral. They have a target price of 1141 on the stock. They say commercial vehicle growth will be moderate. JLR could face demand risks as well. And the targeted EBIT margin of 8.5% in FY25 means that it's going to be a flat year for the Jaguar Land Rover business. And the stock, after the big run-up that we've seen, has reached a fair value to the tune of 5.4 times FY26 EV to EBITDA. Morgan Stanley also downgraded Tata Motors to an equal weight. They have a target price of 1100. They say that the company has delivered on all its major targets. Execution is strong. Business is performing well. However, all of the good news is priced into the stock, and rising competitive intensity both in the electric vehicle, passenger vehicle business as well as in Jaguar Land Rover globally is something that could keep a lid on the stock gains. Back to you.
Okay, all right, Sonia, thanks very much for that very sharp reaction.
On Tata Motors. So last year, when they started the year, they had guided for JLR EBIT margins of 6%. In the middle of the year, they upped it to 8%, and the company finally ended with 8.5%. And Q4, of course, was over 9%. The street was factoring in that the JLR margins will keep increasing in FY25 and FY26. But as Sonia pointed out, that in FY25, that margin increase trajectory for JLR has actually, come to a halt. So that's,
and the market's just in no mood for looking at anything negative. So you can, have better free cash flow accretion, all of that. Market's just not listening. And then to top it off, you have notes. So the one that I was referring to was the Motilal note, because their note starts by saying the best is behind. So when you have that kind of a headline,
says, the best is behind.
So it's a sell now, think later kind of a market that we're in the midst of. And Tata Motors is definitely at the receiving end of that. Good to see that FY25 guidance. Well, we'll just discuss some other sharp reactions in a bit as well. Cipla, for instance, is flying 6% now. But before that, let's welcome in Soni Patnaik from JM Financial Services into the conversation. Soni, thanks for joining in here. Before we can talk markets, discuss index and your stock calls, please throw in a word on Tata Motors, because this is a massive slam dunk on the stock. What would your advice be, given that it's been one of the strongest movers of the last 1 year?
Hi, good morning, Surbhi and Rima. Thank you so much for having me on the show. Yes, definitely. I think Tata Motors has seen the impact of the comments, and, it has given a breakdown today as well below 1,000 levels. So I think going forward, 1,000 is going to become that strong resistance. And, the range that it can caught up in the medium term, maybe perhaps from 920 onwards to 1,000. So I think the next support that we're looking at for Tata Motors is around 920. And, that could be the level one can reinitiate a longs again. So I think it's just a bit of a wait and watch for a few days and let the level settle in. And 920, 930 can be the level to reinitiate the longs.
Okay. By the way, on the Nifty, there has been a bit of an intraday recovery. 21,821 was the intraday low. So we've recovered about 120 points from that, and the recovery largely has taken place in the last 30 minutes. Soni, Nifty trade at 21,950, and then your stock calls.
Rima, I think the Nifty is going to remain quite volatile this whole week. We've seen India VIX rise above 21 levels today. It is just indicating that the volatility is yet to remain. The range for Nifty as of now is 21,750, 700 on the downside, which is a good support. And on the upside, 22,000, 22,100 has become a resistance. So today, aggressive open interest additions can be seen all the major call strike prices from 22,000 starting all the way up to 22,300. So there's a bit of a writing happening on those call strike prices. I think this can be the range for Nifty going forward. Short covering for Nifty can only be seen if it crosses 22,300, which is a bit far-fetched from here on. Expect the volatility, expect these movement, the range play out happening throughout the week, and a lot of intraday recoveries, intraday slowdowns can be seen. Similarly for Bank Nifty as well, if you look at, it's also broken 47,500, which was a support. It's broken completely beyond it. The next support that can be seen for Bank Nifty is 46,600. There's a very broad range for Bank Nifty this entire week, and that trading range is 46,600 to 48,000. So this 400-point range is going to be quite volatile for Bank Nifty. Any short covering for Bank Nifty can only be expected above 48,000. It's best just to avoid the index strategy and stick to stock-specific strategy. So in stocks, there'll be two picks, one buy and a sell. The buying is in Power Grid. We've seen a good option chain breakout happening above 300 level for Power Grid. So current levels, one can buy keeping a stop loss of 295 and a target of 320, 323. The sell idea comes in Chambal Fertilizer. One can sell Chambal Fertilizer futures at current level, keeping a stop loss of 400. A target of 370, 365 can be seen as it has given a fresh breakdown below 400 level today.
Okay, all right, got that. Soni, thank you very much for giving us some of those trading ideas today. With that, we do have to take a very quick break. We'll come back on the other side and then we'll talk fundamentals. The market has been sliding for a while. What should you be doing? Is it a good time to go in and buy? We'll ask Manish Jain, Head of Fund Management at Centrum, on the other side. Welcome back. You're with us on Trading Hour. As promised, let's get that conversation going with Manish Jain of Centrum. Manish, good to have you on the show. And it's been a really wobbly market. Election jitters perhaps setting in, making people offload positions slightly. What have you made of this small dip that we're in the midst of? And what are you doing? Is this a time to go in and buy? Or would you rather stay on the sidelines?
No, I think fundamentally the Indian equity markets continue to remain on a very strong footing. See, as far as the flows are concerned, when you look at the India's inclusion in the bond index, that's going to take care of a lot of problems. In this current quarter, we've seen the rural growth kind of starting to come back. Monsoons are predicted to be normal. Food inflation should ideally kind of come down, which essentially means that the overall inflation trajectory will remain steady. We are looking at a rate cut coming through in this current calendar year. At least one of that should happen. So fundamentally, I think things are all going fine. There are a couple of factors which are kind of starting to pull the market down a little bit, like you very rightly mentioned. Could be a little bit of election jitters. That is one factor to it. Second is a little bit of FII money moving from India into other emerging markets like China. But as long as the business fundamentals are strong, I would still continue to be a very idea-driven, very bottom-up kind of a person. And I would actually go out shop in this current markets. I think there are certain stocks that have kind of corrected meaningfully, and they represent still a great value from a long-term perspective, 3-year perspective. There are certain stocks in the banking sector, autos. Again, we are very, very positive on. IT is another one. I would actually go ahead and buy.
Do you want to, Manish, hi, afternoon. Do you want to tell us about some of these ideas, banking, IT, auto, where you have deployed some of the cash in the last 1 month, given this volatility?
So our construct has really been more leaning towards a large cap now, because if you look at the IT, for example, again over there, even if you look at the valuations from the large cap versus mid cap IT perspective, again, large cap gives you a lot of comfort, and we've seen margins kind of bottoming out in this last quarter and the quarter before that. I think they've fundamentally taken care of a lot of things, and with the US economy being steady, some of these large cap IT stocks actually present great amount of value. Similarly, in the auto space, if you particularly look at two-wheelers, then again, it becomes a great play on urban premiumization as well as rural growth story, which is again phenomenal. And in some large cap banks there, if you look at the top 5, top 6 banks, some of them are actually trading at 10-year, 12-year low valuations, right? Some of these are trading at below 2 times, 2.2 times price to book for stocks that used to trade at above 3.5 times price to book. When fundamentally, from a 3 to 5 year perspective, things look like a large part of the pain is behind us, it's actually the correct time to pick these stocks up. And that's the strategy that we have been implementing. In the month of March, we had created liquidity in the portfolio. We were sitting on 5 to 7% cash across the board in each of our portfolios. And, we are now starting to deploy that money out as we speak.
So perhaps some of the large banks is one of your go-to places. What else? What else are you picking and choosing now?
Large cap IT, larger banks, again, autos is another one where we are very, very comfortable on. Consumption is again something where we have started building up positions now, given that rural growth seems to be coming back in a big manner, both discretionary as well as rural-centric, mass market consumption, again, something. And then we have an overbid position in the real estate sector as well. So that's essentially the area where we are kind of building up positions.
Okay, you mentioned that you've started building up positions in consumption, Manish. Is that at the cost of discretionary? I mean, my question is, have you started trimming from discretionary and then adding to staples? Or are you happy to deploy at both ends of the spectrum?
No, a little bit of money has been taken off discretionary stocks. Some of them have actually been multi-baggers for us, right? 4x to 10x in that range in the last 3 to 4 years. We've actually made a large amount of money in discretionary consumption stocks. So we're kind of booking a little bit of profit there. We did that in April, which was a phenomenal month for the fund. We kind of delivered between 11 to 13% return across the board in each of our schemes. So we kind of took a little bit of money off there and we were sitting on cash. And as we speak, we are kind of starting to deploy that money back into some of more staple-oriented stocks, which have not done well for the last 3-4 years, but have a great potential from here onwards, given that overall inflationary trajectory kind of remains a little benign and the fact that rural growth is starting to come back.
Thank you. Thank you very much for joining in. Get into a break. On the other side, we'll invite the management of Intellect Design Arena. The stock was under pressure on Friday, post the Q4 numbers. Arun Jain will join in on the other side. Stay tuned. Welcome back. Let's move on to another corporate conversation. Shares of Intellect Design Arena continue to remain under pressure. Remember, the stock was down close to about 15% on Friday after posting a weak set of Q4 numbers. One of the key reasons for the weakness in Q4 is that the government e-marketplace contract, the GEM contract, largely ended in the quarter gone by. We have with us Arun Jain, Chairman and MD of Intellect Design Arena, to take a few questions. Mr. Jain, morning. This is Reema here. The impact of the GEM contract aside, the global e-marketplace aside, the revenue growth last year was close to about 14%. And I know in the past you've always maintained that your company is designed for about a 20% growth. So you've fallen short of that aspiration. So if you could just lay the context, what happened in FY24 and what can you guide for FY25?
Thank you for inviting me for the conversation. So stock has taken a beating, which is not required, because whatever we have discussed in the last conversation on the TV media is that GEM was not profitable, though it was adding a revenue to the top line, which we have published the GEM number, which is clearly visible. We grown 7% quarter on quarter. Our EBITDA numbers are improved by 2 percentage points, so 20%, it moved to 20 to 23%. That's what we guided the market. And DSO has come down from 110 to less than 100 days without GEM. So these are the right metrics which we are tracking down. So 14% growth is lower than the design growth of 20%. So that's what we are looking. 3-year LTM. 3-year LTM is still 19%. So the quarter-to-quarter prediction in a product model is a difficult thing. Last year, we lost 2 large deals. One because of political reason with one of the North American country, where we were almost chosen party, but because the Canadian government didn't want to work with Indian vendor, we lost that deal and that RFP got cancelled. And the second GEM last quarter revenue. So these are the 2 major blocks of shortfall between 20% design growth and actually what we have achieved.
Sir, I understand that while quarter-on-quarter prediction is, close to impossible for a product company, but 14% growth last year, and even in the conference call, you're guiding for a 15% revenue growth for FY25 if you remove the GEM impact. So again, it's not still at that 20%. So what are you baking in for FY25? How do you get to 15%, and why not 20?
Yeah, we love to have 20% growth, and we designed the business plan for 20% growth. But now, last year we achieved 14%, so we want to be cautious with the investor to keep it at the same level at 15% growth numbers, which we are baking in for 25 number. But your EBITDA margin, we may improve from 22% by another 2% more, so it could be 24% number could be there. In EBITDA side, DSO will be improving. So overall, I think it's and we have an investment to make in AI business. So eMAG.ai is really taking a big traction right now. And that eMAG.ai, what we have launched last year, more than 50 deals have happened. Last quarter, if you observe, there are 8 deals in North America, and 6 deals out of them is AI deals. So it's a good beginning to show that our AI is picking up in a market. eMAG is picking up in a market. And these deals are across all the continents, all the 6 markets: Australia, APAC, Middle East, India, Europe, and Americas. So very few companies can forecast that a product is acceptable in all the markets. So eMAG.ai, yeah.
Yeah, so Mr. Jain, so just a point, and would you mention that a lot of these deals are coming from various continents? Because I just wanted to ask you, one of the deals that you missed out on, and you cited political issues over there, in your bid pipeline, do you have any more deals with Canada as the backdrop? And I mean, is there any further risk of a repeat happening there? How important is Canada as a geography for you?
Canada as a geography is very good, and we have a large traction in Canada. It's a government deal which created the problem, not as a geography. Commercial banks are really loving our proposition there, so we are winning more deals in Canada. It's only the government deals. It was more.
Okay, got it. It was a government deal which didn't go your way. Understood. So on margins, and you mentioned there are a lot of sort of the deals that involve AI. I mean, they're also working well for you. So you, at the end of fourth quarter, are at about 22.2%. So is this level sustainable? Do you think there's scope for improvement as we roll forward in this year?
Yeah. We are saying that it can improve up to 24%. 22.2% can go up to 24% on yearly basis. So don't count me on quarterly basis. Every quarter I'm not able to maintain it, but 24% is doable in this. Well, that's what we planned for. So we plan for 25%, 24% will be doable this year on EBITDA margin. So that's what we are looking at.
Okay. While 2 large deals didn't fructify last year, even in Q4, you did say that some deals got delayed and some got carried forward. Are these some smaller size deals, and what can you guide in terms of deal closures? Are you getting impacted on account of that? What was the size of these deals which didn't materialize in Q4, which hurt you?
Yeah, I think this is a regular phenomenon now. Anybody who's tracking the stock over the last 3 years will find some deals are getting postponed. This may be in the range of $2 to $5 million typical deal size, which can shift from quarter 1 to quarter 2. So some quarters like last year, Q4 become extremely good. So this is not a quarter to quarter story, but yeah, as you are specifically asking Q4, that is what I would like to say. That's $2 million deal is getting postponed for the next quarter.
Okay, all right, Mr. Jain, we'll leave it on that note, and wish you better luck for the first quarter that we're in, and of course for the rest of the year as well. Thanks for joining in. On that note, we do have to take a very quick break. We'll get you more on the markets in just a bit. Welcome back. Voting for the fourth phase of the 18th Lok Sabha elections is underway on 96 seats across 9 states and 1 union territory. Some major states such as Bihar, Andhra Pradesh, Telangana, West Bengal, Uttar Pradesh and Jharkhand go to polls today. Parikshit is here with all the details. Parikshit, tell us about the contest today.
Well, it's going to be a very tight contest all the way from Jammu and Kashmir in the north to West Bengal in the east and Telangana and Andhra Pradesh in the south. Srinagar will be very important. Srinagar is witnessing the first election after the abrogation of Article 370. And if in 2019 there were 12 candidates in the fray, this time there are 24 candidates in the fray in Srinagar. So that's a battle we'll be watching out for. But I'll come to Srinagar a little later. First to Andhra Pradesh, which may really hold the fortunes for political parties in this phase. Why am I saying that? Because the elections in 3 phases or almost in half the country is already over. Now, why would Andhra Pradesh be key? Well, it has 25 Lok Sabha seats. 22 were won by the YSR Congress last time around. This is Jagan Mohan Reddy's party. It also has 175 assembly seats which go to polls today. Simultaneously, the YSR had a landslide victory with 151 seats and 22 Lok Sabha seats last time around. This time, the NDA with the TDP and the Janasena party is making a major push. They want to make sure they win big in the state of Andhra Pradesh, which can increase their overall tally. Look at the numbers last time around. It was 3. And that's why this state is very crucial for the BJP and the NDA to move closer to their 400 plus mark. So in this alliance, the TDP is contesting 144 seats here. The Jan Sena is contesting 21. And you also have the BJP contesting 10 seats. So what is the YSR Congress and Jagan Mohan Reddy really counting on? Welfare schemes and continuation of welfare pensions, increasing them from 3,000 to 3,500 rupees. When it comes to the TDP, they want to give unemployment allowance of 3,000 rupees per month to the youth. There is also a major debate over Muslim reservation. The YSR Congress has promised that the 4% Muslim reservation will continue, whereas the BJP has said it will end reservation based on religion and it will only be on social reasons. Let's move on to the state of Telangana, which will also be a very, very crucial election. Now, this is a state which has 17 Lok Sabha seats going to polls. 9 were won by the BRS, 4 by the BJP, 3 by the India Alliance, 1 by the AIMIM. Hyderabad is a place where Asaduddin Owaisi of the AIMM is trying to retain his seat, and he is up against a novice from the BJP, Madhavi Lata, who's very enthusiastic, and the Prime Minister, also Amit Shah, Rajnath Singh. They've campaigned a lot in Telangana as well. It's a battle for survival for K. Chandrasekhar Rao of the BRS. He's been campaigning all across the state despite his ill health. Leaders like Rahul Gandhi, Mallikarjun Kharge, they've also gone to the state, which shows the political importance. So Telangana and Andhra Pradesh will be very critical, apart from states like West Bengal, Bihar, Madhya Pradesh, Maharashtra, which also go to polls today.
Okay, thank you very much for that, Parikshit. That's the South Side story now on elections. With that, it's a wrap on Trading Hour. From the entire team, thank you for watching.